American government, welfare and income policy. Economic class has not been as big a part of American politics as it has been in Europe. Labor unions have always been weaker here. Only about 1 in 8 American workers belong to a union today. Europe also has a tradition of working class parties, like the Labour Party in Britain or the Social Democratic Party in Germany. The United States doesn't have and has never had a major labor or social democratic party. The reason is the cultural differences between the United States and Europe. Class awareness is and always has been much stronger in Europe, which has lent support for labor unions and working class parties. The United States culture emphasizes individualism, the citizen achieving his or her own goals through the dint of their own blood, sweat, and tears. It makes it harder to organize collective action around the workplace. The fact that economic issues are less important to the people of the United States does not mean, however, that they're insignificant. During the 1930s Great Depression, economic policy was on everyone's mind. The minimum wage, collective bargaining, those came about of the Great Depression in the 1930s. Today, economic issues are back to the forefront. The economic downturn that began in 2008 cost many Americans their savings and their jobs, and for a variety of cultural, demographic, and political reasons, the economic recovery from the recession was incredibly weak. Additionally, for the average American worker, wages have been stagnant for the last few decades, while at the top incomes continue to grow. Generational differences are also playing into this economic issue. Many young people today believe that their generation of young adults will be financially less well off than their parents, which is a perspective not typically held by Americans. These developments have made economic issues an increasingly important part of American politics. That term class refers to people who share the same economic status. Some people are well off and are sometimes referred to as the upper class or the wealthy. Others make enough money to have a comfortable lifestyle, though not one free of financial worry. They're typically referred to as the middle class. Then there are those who live almost exclusively paycheck to paycheck and occasionally tap into government assistance, and they are often called the working class. Finally, there is the lower class, or the poor, those that routinely struggle to keep food on the table and a roof over their heads, and often rely on a cornucopia of government programs, staff, and charity for the means of survival. For most people, financial well-being is chiefly a question of employment, what type of job they hold, how secure it is, and how well it pays. But government policies also play a role in how society's financial resources are distributed, and in how incentives to work or to not work impact the lives of ordinary citizens. The federal government today operates a spiderweb of social welfare policies, those that help people meet their basic needs, and income policies, those that help people get ahead financially. Poverty is a persistent and stubborn problem in the United States. Although the U.S. has far less extreme forms of poverty than many and most other countries, it has more poverty than comparable ones, Western countries. Its self-determined poverty level, which is set and determined by the federal government and measured, a certain dollar amount depending on family size, is twice that of France and Germany. It's also significantly higher than that of Great Britain and also that of its northern neighbor, Canada. The U.S. government uses the cost of living as the basis for dividing the poverty line, which is the level of income below which a family is defined as poor and thereby eligible for certain forms of federal public assistance. The federal government sets the threshold for poverty as the annual cost of a thrifty food budget multiplied by 3 to cover the cost of housing, clothing, and other necessities, again varying on family size. There's a chart. By the government's formula, which is adjusted every year, about 1 in 7 Americans today lives in poverty. It's about 50 million people. America's poor include individuals of all ages, races, and regions, but it's concentrated among certain groups. Minority group members have a poverty rate twice that of white people. Women have a poverty rate exceeding that of men. Children are one of America's most impoverished groups. Roughly 1 in 5 American children live under the poverty line, most of them in single-parent family households headed by a mother. Until the 1930s Great Depression, state governments had responsibility for their poor. Welfare was among the policy areas deemed reserved to the states by the 10th Amendment of the Constitution. That thinking changed as a result of the Depression, a period where 1 in 4 workers could not find a job, at least for a time, and another 1 in 4 only could find part-time work. Incomes fell sharply during that decade, and as they did, so too did state tax revenues. Most states were too broke to help their poor. Many poor people literally drove, hitchhiked, or rode trains from state to state looking for work, especially men. Federal tax revenues had also declined during the Depression, but unlike the states, the federal government has the power to print and borrow new money. During the Depression, the federal government was in the hands of officials, President Franklin D. Roosevelt and a Democratic congressional majority that had no qualms about using the federal government's spending power to help the poor. Most Depression-era poverty programs were meant to be temporary, such as the Works Progress Administration, which put millions of people to work constructing roads, hospitals, and the like. But a few of FDR's programs were designed to last, including Aid to Families with Dependent Children, or AFDC, Aid to Dependent Children. It provided financial assistance to poor single mothers, those who had little or no income because of a father's death or desertion. The second wave of anti-poverty programs came later in the 1960s, when the federal government was, again, in the hands of a Democratic President, Lyndon Johnson, and a Democratic Congress determined to help the poor. They enacted the largest set of anti-poverty programs in the nation's history, including the food stamps program. It's called food assistance today. Subsidized housing via the Housing Act, Section 8 housing, you may have heard the term, and Medicaid, which is government-paid health insurance for those of low income, Medicaid. These programs represented Johnson's war on poverty. The war on poverty is what he called it. And these programs had a lot of public support. A Gallup poll at the time found that 2/3 of Americans believe that the government has a responsibility to try to minimize poverty in the U.S. Programs also had an element of bipartisan support. Republican lawmakers from New England and the upper Midwest, states like Wisconsin and Minnesota, strongholds of the party's progressive tradition, strongly backed these new programs. Johnson's Great Society program efforts represented the height of the government's anti-poverty efforts. Since then, there have been only a handful of new programs enacted, including the 2010 Patient Protection and Affordable Care Act, i.e. Obamacare, ACA, which, among its provisions, expands Medicaid eligibility and provides subsidized health insurance to low-income families. There have been a few cuts along the way, not many, most notably the bipartisan 1996 Welfare Reform Act, which reduced the welfare rolls and sought to end the generational cycle of poverty by limiting the length one could receive unemployment benefits, and by incentivizing many able-bodied recipients to secure gainful work. As you might recall from an earlier session, that 1996 legislation eliminated the aid to families with dependent children, which had placed no limit on how long a family could receive benefits. In its stead, that 1996 law created the Temporary Assistance for Needy Families, Temporary Assistance for Needy Families program, which limits eligibility for most families to 5 years and is administered by the individual states. Popular programs such as food stamps, actually SNAP, Supplemental Nutrition and Assistance Program, that's what it's called today, SNAP, and Medicaid, they're both public assistance programs. They're labeled as such because they're funded with general tax revenues and they're available only to the financially needy. Public assistance programs are means tested. Recipients must prove they are poor in order to qualify for the benefits, a requirement that adds to the program's expense. In addition to payments to recipients, which both do, there are administrative costs associated with determining whether an applicant's income falls below the designated amount. These costs account for about 10% of federal spending on food stamps or SNAP and about 5% for Medicaid. Means testing is consistent with America's culture of individualism, the belief that people should be self-reliant. That belief supports the notion that public assistance should be available only to those who can prove that they are unable to make it on their own. To make it widely available or just publicly available would disincentivize work and run counter to America's foundational concepts. The distinctiveness of the American approach becomes obvious when comparing the United States healthcare system with most of those in Europe or everywhere else around the world generally. In other Western nations, specifically, residents of all income levels are generally entitled to government-paid medical care. If they become ill, they simply go to a clinic or hospital for treatment at government expense, no questions asked. In contrast, Americans receive government-paid health care only if they meet the eligibility requirements. Even then, to be eligible, they must apply beforehand for insurance and prove that they are too poor to buy that insurance on their own. There's another feature of the American welfare system that's distinctive. Consider, for example, the difference in the monthly assistance payments to poor families depending on where they live. The payments range from less than $800 a month to $1,800 a month or more, depending on family size. Because of America's federal system, most public assistance programs, although funded primarily by the federal government, are administered by the states, which have a degree of control over benefits and eligibility. There's considerable variation in the amount of family assistance that states provide. Some states offer more, some states offer less. They choose how they allocate those dollars. Public assistance programs are not America's only social welfare policies. These policies also include what are called social insurance programs. As the name implies, they are based on the insurance principle. Individuals must pay into the program in order to receive benefits. Social Security is the leading social insurance program in the United States. Established in the 1930s as a part of Franklin Roosevelt's New Deal, following the model held by many European countries, it provides monthly payment benefits to retirees who paid Social Security tax on their income during their working years. The Social Security tax rate is about 6.2% currently. That amount is deducted on payday from all American workers' wages before they ever see a cent. Social Security is an entitlement program. Entitlement. That means that if an individual meets the eligibility requirement, he or she is entitled to the specific designated benefit. The government cannot decide one day to cancel an entitlement program or to grant the benefit to some previously eligible recipients while denying it to others. Its obligations are permanent. You will receive payment from the Social Security Administration when you reach a designated age based on eligibility criteria and a formula set by Congress that calculates your payout based on your years of work and your total earnings. Public assistance programs don't offer this type of protection. They are not entitlement programs. The poor do not have an unqualified claim to such benefits. Government can choose at will to cancel such a program or change its eligibility criteria. When Medicaid, the federal health care program for the poor, was enacted in 1965, Congress also enacted Medicare, which is health care for retirees. Medicare. Huge program in the United States. Medicare is a social insurance program. As is the case with Social Security, it is financed by a special tax, currently about 1.5% of all workers' wages, again, before you ever see a penny. Social Security and Medicare are federal programs in their entirety. States do not administer them or have a say in eligibility or benefits or requirements. Accordingly, recipients get the same level of benefits regardless of where they reside. Social Security and Medicare are efficient programs in the sense that they are fairly straightforward and simply managed. When workers reach the prescribed age and conditions of eligibility, they automatically qualify for the benefits. Less than 1% of Social Security spending is eaten up by administrative costs. Medicare is more administratively complex in that it involves payments to doctors and hospitals for personalized care and requires a vast bureaucracy of management. Just over 2% of Medicare spending goes to expenses other than patient care. Where both programs are inefficient is that, in essence, they operate as intergenerational wealth transfer schemes. The math behind such programs worked very efficiently for many years, even decades. A growing American population plus positive economic growth rates sustained the programs for decades. However, as demographic challenges, namely lower natural birth rates plus reduced immigration to the United States, come face to face with a rapid graying of our workforce, more and more people are retiring. The shrinking number of full-time American workers today simply cannot sustain payments to the accelerating number of retirees. And so the programs now operate in a permanent deficit that compounds annually and grows more acute each year. One potential solution would be obviously increase growth rates, increase birth rates, or raise the percentage of your check that's going in currently to fund retirees. That would be a non-starter for a lot of American voters. This is why these programs are sometimes called the third rail in American politics. No one wants to touch them. Social Security and Medicare are not poverty programs in the literal sense. Recipients come from all income groups. In fact, the higher one's income while working, the larger the Social Security payment one will receive upon retirement. You paid a lot more money in. Such individuals pay more in Social Security taxes during their working years and accordingly get a larger benefit when they retire. The average monthly benefit currently is about $1,750, whereas some earners get about $3,500. There's a cap on it. Social Security was implemented to ensure elderly Americans against hopeless poverty in their non-working years. The Depression laid that bare. Although the program has had some unexpected impacts on human behavior, including a notable fall in U.S. birth rates after its introduction, and a pronounced decline in individual family savings rates, public assistance and social insurance programs remain incredibly popular in the United States. Polls indicate that most Americans are convinced that Social Security, a social insurance program, is worth funding, even though skepticism about future benefits is growing among the American people. Americans have a far less favorable view of public assistance programs. The differences reflect America's cultural values, once again. social insurance programs are funded by special payroll taxes on workers, and in that sense are widely understood as something that most recipients have earned into. In contrast, public assistance programs are widely seen as handouts, needed by some, sure, but undoubtedly abused by others. This view makes public assistance programs a political target, especially by proponents of traditional American values, including individualism, hard work, family responsibilities, etc. A partisan gap between Democrats and Republicans tends to emerge among lawmakers on such programs. After the Great Recession had finally faded, for instance, congressional Republicans sought a $40 billion reduction in the food stamp program, settling for an $8 billion cut after a threatened veto by Democratic President Barack Obama. Such programs tend to expand rapidly during economic crises, when it is more politically difficult to oppose enhanced public assistance. Those same programs often see their benefits stay flat or only gradually decline during intervening years. In contrast, programs like Social Security have withstood the test of time. In 2005, President George W. Bush proposed to partially privatize Social Security. Workers would have had the chance to place a portion of their Social Security tax payments, the money that's going out of their check, into a personal retirement account that they themselves could control. Such a move was believed to appeal to many younger voters who expressed concerns and continue to express concerns that they are paying into a system that they believe may not be as generous when they retire. Bush was forced to back down in the face of strong resistance from senior citizens, spearheaded by the AARP, a powerful senior citizen interest group that's one of Washington's most powerful lobbies and interest groups. Cultural values continue to influence poverty policy. Poll after poll over the past 50 years has found that Americans, consistent with their cultural beliefs, see jobs rather than public assistance as the best answer to poverty. Not surprisingly, that principle is the basis for some federal poverty programs. The work requirement for the Temporary Assistance for Needy Families, TANF, program is one example. Another example is the EITC, which is shorthand for the Earned Income Tax Credit. EITC, Earned Income Tax Credit. The Earned Income Tax Credit was created in 1975 when Republican Gerald Ford was in the White House and Democrats controlled Congress. And the program was the brainchild of monetarist Milton Friedman. The EITC provides a refundable tax credit to low-income workers. If your job pays relatively low wages, below about $20,000 a year currently if you're single, you get this credit with the amount varying by family size and earnings. The average recipient gets a refund of about $3,500, which is obtained when filing one's annual tax return. EITC is quite literally a reward for working, a program that's in line with America's cultural values. Similarly, the Child Tax Credit, which was created by Congress in 1997, the Child Tax Credit, reflects cultural values by offsetting via a tax credit the cost of raising children with an eye on moving more families out of poverty. I should mention here that many other nuances of the U.S. tax code enforce and incentivize other human behaviors, not just for those in poverty. Both the SALT, or the state and local tax, and mortgage interest deduction seek to offset the tax burden on upper and middle class homeowners, for instance, particularly those living within high states. A Trump-era rule change that reduced the SALT cap was met with an outcry from Democratic members of Congress intent on preserving the benefit for their high-income constituents, and presumably their high-income major campaign supporters. Though it varies each year, reliably more than half of America's wage earners now earn back more in tax credits than they pay annually in federal taxes. This is why so many people look forward to their tax refund. Many of these folks are receiving more money from the government than they paid in taxes all year long, often on the order of many thousands of dollars annually. The tax code, or progressive income tax code, administered by the IRS, is carefully designed to bring people into the tax system and encourage work over reliance on government. In some ways, the IRS has become a benefits administrator, not a tax collection agency. Let's shift the focus to income policy, government policies that affect people's livelihoods. Until the 1930s Great Depression, the federal government generally sided with business in its dealings with workers. Efforts to organize unions and improve working conditions were repeatedly blunted by state and federal government policy, particularly at the state and local levels. That changed dramatically beginning in the 1930s. After the onset of the Great Depression, congressional Democrats had their largest majority in a century and enacted pro-labor legislation, including the minimum wage law and collective bargaining rights. Congress also made the personal income tax more progressive, meaning that the tax rate was gradually increased for higher incomes. That remains the case today. The Depression lingered still for a decade. Between 1950 and 1970, the American economy, finally grew. And it did so at an unprecedented rate. With that, workers' incomes rose at a record pace, spawning a burgeoning middle class. This economic boom was fueled in part by the strength of America's manufacturing sector, which had been built up in part by wartime investments. The United States had become far and away the world's manufacturing sector, think China in the past decade, on steroids. In addition, the U.S. had emerged from World War II with its factories intact, whereas those in other major industrial nations like Germany and Great Britain had been decimated by the war. It was a boon for America's factory workers, and generally speaking, the best paying factory jobs were those held by union workers. Flexing their collective bargaining muscles, they were able to secure high wages and in many cases health insurance, disability insurance, etc. At the height of union activity in the 1950s and 60s, a third of America's workers were unionized. The minimum wage was also a contributing factor, particularly for unskilled workers. It put a reliable floor on their income and had the added effect of pushing up the hourly pay of others. It also disincentivized forms of work, or gradually automated those tasks that did not meet the new federal minimum wage requirement. But you'll never see that reality reflected in the government-issued unemployment statistic. But I digress. Much more dramatic than minimum wage laws was the impact of the GI Bill, which Congress had enacted near the end of the World War II. It gave military veterans cash payments for college and vocational training and provided nearly interest-free loans for home purchases and small business ventures by these veterans. Before the GI Bill, college and home ownership were perceived as out of reach for many families. By the time of the original GI Bill expired in the mid-50s, nearly 8 million veterans had participated in its education benefits, 2.5 million had acquired a home loan, and hundreds of thousands had received small business and farm loans. The impact was felt from Main Street to Wall Street. The upward momentum of these gains I described did not last forever. Since the early 1970s, most Americans have seen almost no growth in real income, which is income adjusted for inflation. This is, at least in part, a reflection of President Nixon's 1971 abandonment of the post-war Bretton Woods system backing our dollars. Since we severed our connection to the gold standard in 1971 and closed the gold window, the bottom quintile, next to bottom quintile, and middle quintile wage earners are no better off today than they were back in 1971, nearly half a century ago. In other words, the wages of the bottom 60% of workers have been flat year after year, as you can see from this chart here. In terms of real income, their pay has stagnated. In contrast, the top 2 quintiles have enjoyed incredible wage growth. To learn more about the consequences of Nixon's decision to close that gold trade window in 1971, you see a ton of charts at WTFhappened-in-1971.com. Even more than that top quintile, the biggest winners have been at the very top. Since 1971, the percentage of all national income earned by the top 1% of America's earners has jumped from about 10% to about 20% of all total earnings. In other words, their real income has doubled relative to all other earners. The median yearly income for this group exceeds $750,000. I'm sure it's $1 million today. The top 1% are about positioned where they were in the end of the 1920s, the so-called Roaring 20s. After the 20s, the top 1% saw their share of income decline substantially relative to other earners through the Depression. But in the past 5 decades, they've climbed back to that earlier point. So what explains this development? Commenters regularly link the two, as if income gains at the top are the main reason for income stagnation at the bottom. But in fact, the two developments are totally unrelated. Wealth is not a static dollar amount that is divided between people. There isn't a certain amount of dollars in our system that gets shared by both the wealthy and poor alike. Our collective wealth, expressed through metrics like the gross domestic product or GDP, can swing wildly from era to era, as it did in the Roaring 20s and the Great Depression. Indeed, if there were a static amount of dollars, how could you have a depression if the dollars didn't disappear and people didn't burn their money or something like that? The explanation for why high-income earners have done so well and general wage earners have stagnated since the 1970s for most Americans owes substantially in changes to American federal public policy in concert with actions by the Federal Reserve. You'll recall from a previous session the discussion of the supply side of fiscal policies championed by Ronald Reagan. The assumption underlying these policies is that a reduction in taxes on business and high-income taxpayers will stimulate investment in the short term and economic growth in the long term. resulting in budget surpluses and removing the need for so much spending on entitlement programs. In reality, however, federal spending has not been reduced to better align with reduced tax revenue. It has actually accelerated since 1971. More Americans are being shielded from paying high taxes, which has obvious knock-on benefits. But instead of responding to shrinking budgets by reducing the size and spending of our government, as conservatives long hoped, Congress has seen fit to actually expand government services further despite the reduction in tax income, to run larger and larger deficits each year. Today, congressional spending channels modern monetary theory, MMT, a not-so-modern theory that holds that since the United States issues its own fiat currency unbacked by any real asset, the U.S. can run larger and larger deficits in perpetuity, so long as the Federal Reserve or other buyers of our U.S. treasuries continue to buy this debt. It is not a coincidence that this trend dates back to about 1971. This is the same year that Richard Nixon ended the so-called Bretton Woods system that had preserved a form of the gold standard after World War II came to a close. Bretton Woods, a conference they held in New Hampshire. Once Nixon was under intense pressure from Europe, specifically France, to unpeg the US dollar from gold, all global currencies gradually moved to a free-floating exchange system. Instead of being backed with gold, national currencies became national commodities, backed not by actual money, but by fiat or decree, confidence in the government itself. $36 bills bought you an ounce of gold in 1970. At the time of this recording, the dollar has lost so much value, it would take you over 2,000 of those same bills to buy back the same ounce of gold. This is why your grandparents talk about 5-cent candy bars, for instance. It's not that prices have gone up, it's that the dollar has weakened incredibly. Other public policies have also contributed to the income gap. Reductions in capital gains taxes have overwhelmingly favored the wealthy, as have lower and lower interest rates, a 40-year trend supported by the Federal Reserve. The wealthy by far own the largest share of publicly traded stocks, the gains from which are taxed at a lower rate than the tax on income. Increasingly, wealthy Americans have responded to incentives from Congress to structure their income streams in ways that help protect them from paying much in the way of income taxes at all. This is how someone like billionaire Warren Buffett, who famously advocates for higher taxes, can end up with a tax bill in less than 1% of his annual earnings. Financial deregulation and trade agreements, like NAFTA, the North American Free Trade Agreement, have also disproportionately worked to benefit consumers, not earners. The outsourcing of production through policy decisions and initiatives has resulted in cheaper goods for Americans, but it's come at a loss of good-paying jobs here in the U.S. I could provide other examples too, but the point would be the same. America's wealthy have benefited substantially from public policy changes since the 1970s. Democrats have framed their argument in terms of fairness and suggest that raising taxes would somehow alleviate these issues. But in truth, their proposed tax increases would have a negligible effect on actual tax revenue collection. Meanwhile, Republicans have framed their tax cuts arguments in terms of economic growth. But experience has proven that without corresponding cuts to spending, this hasn't shown no benefits either. It just adds to the deficit. The heart of the issue is far more complex. Depreciation of an unbacked dollar paired with demographic challenges and a culture that values work very differently than it did just a few decades ago. Neither side in the wealth stratification debate has shown any willingness to really compromise or seek a shared understanding of the challenges that lay before us. In 2013 and 2018, for example, congressional deadlocks over taxing and spending, specifically debates over continually raising the debt ceiling limit that caps the amount the government, Congress, can borrow, led to brief federal government shutdowns of the government. It seems the only thing Congress is willing to eventually agree on is how much more they should borrow from foreign and central bank creditors than they did the year prior. And they only do that when it all falls apart. Let's turn to the problem of stagnant wages. The manufacturing sector economy that America had after World War II, with its good-paying factory jobs, has given way to a service sector economy. Until 1971, the United States was a net exporter. Manufactured goods made in America were being sold around the world for more than in value of our imports. We were selling more than we were buying. In terms of global trade, more money was reliably coming into the country than was going out. Since then, the United States has been a net importer, buying hundreds of billions of dollars more in goods from abroad than it sells in those same markets. Millions of good-paying factory jobs have been lost in that process. That loss has been accompanied by a sharp decline in union membership. Today, only about 1 in 9 workers is a union member, and most of them work not in the private sector, but in the public sector, such as teachers, police, and civil servants. Less than 10% of private sector workers today are unionized. Since the 1970s, job growth has come overwhelmingly from the service sector, areas such as banking, rental services, healthcare, entertainment, fast food, housekeeping, etc. Jobs that are not easily outsourced. You likely intuitively understand that service sector work tends to take the form of lower pay, lower responsibility labor, and gig work. Waiters, store clerks, bartenders, hotel staff, artists, Uber drivers, etc. Their take-home pay generally is substantially less than their factory working counterparts just a few decades ago. It's also the case that service sector jobs generate less economic activity for the country than factory jobs do. Jobs generate jobs. That's a basic axiom of economics. Those who work at restaurants, for example, support jobs for workers in firms that supply food and drink to restaurants. Over the course of a year, the average service sector worker generates about $100,000 in related economic income activity. That's what they enable. And that's why they're paid a wage. Now, it might seem like a lot, but it's substantially less than the average for a manufacturing job. That figure is closer to about $300,000 in net benefits. Consider auto workers. When new cars leave the factory, they generate lots of economic activity. They support car dealerships, gas stations, repair shops, auto parts makers, auto supply stores, and more. Furthermore, the car they build helps someone else move up the ladder potentially, find better economic opportunities farther away from where they live. Factory jobs have a much larger job multiplier than do service sector jobs today. America's transition from a manufacturing economy to a service sector economy reflects a variety of economic factors and policy choices made by our Congress. The U.S.-dominated global market that existed after World War II has given way to a highly competitive global market, where U.S. firms must compete with those of Japan, Germany, South Korea, China, Brazil, Vietnam, Mexico, and other countries, some of which have the comparative advantage of weaker currencies and lower wage and environmental standards. Where public policy fits into the story of wage stagnation is largely a story of what the government has not done. Government has shied away from initiatives that could boost employment and wages, including new investments in infrastructure spending, for example. In the 20th century, the federal government launched a wide range of infrastructure projects, everything from the Tennessee Valley Authority to the interstate highway system. The latter, initiated in 1956 at the urging of Republican President Dwight Eisenhower, resulted in the construction of 41,000 miles of new multi-lane highway, which temporarily provided hundreds of thousands of construction and construction-related jobs, but much more critically, allowed Americans to move, trade, and develop more freely among these fast-moving new arteries of the nation's economy. Ambitious infrastructure projects have been proposed and then shelved for many decades now, reflecting a dominant modern preference for short-term spending bills that keep voters today happy, but at the cost of investments in America's strength for our future. Is there such a role for our government in the 21st century? Can government help get us back on track? The answer is yes, but it will not occur until Americans and their representatives again look beyond their own station toward the nation's future. A few years ago, a massive study of the condition of America's infrastructure, its highways, dams, schools, and other public facilities, gave the United States an overall grade of a D+ on an A to F scale, concluding that trillions in new infrastructure spending would be needed at the federal level to address, even just to maintain our aging infrastructure systems. When Donald Trump took office, it was my hope that he and his policy advisors would target the nation's infrastructure, a cause he was aligned with Democrats on. But the specter of partisanship crushed such hopes. And every year that we prioritize our own economic benefits today means we leave a greater challenge to Americans in the future. We chose intentionally many decades ago to accelerate the trend towards services and consumption and away from investment and production in this country. It's no accident that over 1/2 of American adults today live paycheck to paycheck. This is, by and large, a collective lifestyle choice we've made. At very low inflation rates, foreign and domestic appetites for all of this debt, and outsourcing of production permitted for nearly 2 full American generations. Many are now beginning to see just how vulnerable such arrangements leave us. We face a perilous and an opportune moment in terms of our financial system today, like we did in 1930 and in 1945 and again in the early 70s. In all 3 instances, federal monetary policy adjusted rapidly, and Americans were thrust into a new financial order. In 1929, we confronted a prolonged depressionary event that shocked the world. In 1945, we confronted high inflation during a period of growth and monetary expansion, which helped minimize our incredible war debts. And in the 1970s, it was the end of the gold-backed monetary policy and the onset of stagflation, that was eventually crushed by Federal Reserve lending rate policies that drove mortgage and savings rates in the United States to well over 10 to 15%. Events in our lives may seem dull and ordinary, but every American moment is meaningful and a part of our larger American story. We are now living through a particularly meaningful one. No president can solve these problems, and solutions will not come easily to policymakers. But America can, looking inward and staying focused on unity, find a way through the present challenges together. Tomorrow will simply look different from today, and that's not something we should fear. In fact, it may be for the best. And in the meantime, scrimp and save and invest in safe assets that you can allocate to future growth.